Howdy, everybody. Welcome to Liberty Call. Today is Monday, July 22nd, 2024. Hope you're having a fantastical day out there in the interwebs. Pretty nice day here in Colorado. It was quite chilly today. I think the high didn't even hit 70, so pretty nice. Got some sun. It's been kind of overcast most of the day, but you really don't care about that. You're probably sweating wherever you are, especially if you're down in Texas, where most of the people that I know are at. Anyways, all right. Well, if it is your first time watching Liberty Call, if you could give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. All righty, let's get into today's numbers. Looks like the markets were in a better mood today than last week. Dow Jones finished the day up 0.32%, 127 points, closed at 4415. S&P 500 was up 1.06%, 58 points, closed at 5563. NASDAQ up 1.57%, 277 points, closed at 18004. Looks like the tech sector really jumped today. The Dow actually dipped into the red for a little while. The VIX was down 10.05% today. It's at 1486. Canada was up 0.8%. Brazil was up 0.26, and Mexico up 0.63. In Europe, Germany was up 1.35%, the UK up 0.53%, France up 1.16%, Netherlands up 1.06%, Spain up 0.51%, Italy up 1.17%, Switzerland up 1.05%, and Portugal up 0.85%. Russian exchanges both in the green today. The MOEX up 0.6%, RTSI up 0.87%. And the overnights, the Nikkei in Japan was up 1.28%. Australia down 0.5%. New Zealand down 0.64%. In China, the Shanghai was down 0.61%. The Shenzhen Component down 0.38%. China A50 down 0.44%. DJ Shanghai down 0.48%. The Hang Seng was up 1.25%, and the Taiwan weighted down 2.68% for the day. All righty, good stuff there. Let's move on over to our weekly economic update. Stocks were under pressure last week as investors appeared to rotate out of mega cap tech stocks and into areas that may benefit from lower interest rates. Wouldn't lower interest rates benefit mega cap stocks? Because typically growth stocks do better with lower interest rates. So that doesn't make any sense. Whoever wrote this for me, you're fired. Just kidding. The S&P 500 fell 1.97% last week. NASDAQ declined 3.65%. The Dow Jones was up 0.72%, and the internationals slid 1.48% through Thursday's close. The Dow leads again this week. The week began very different than it ended. All three averages rallied over the first couple of days of this week, with the Dow leading on both days. Fed Chair Powell indicated that the Fed may not wait for inflation to reach its 2% target before considering a rate move, buoyed the markets. Then the markets hit a speed bump as investors appeared to take profits and rotated away from mega cap tech names. The selling broadened beyond tech-related names on Thursday, as all but one of the S&P 500's 11 sectors fell. Early Friday morning, a global tech outage caused disruptions for businesses, governments, and financial institutions, contributing to the weekly decline. Despite its losses in the second part of the week, the Dow finished in the green. All righty. Upbeat economic data. Although stocks were under pressure, some investors saw green shoots in a few economic reports. Housing starts rose 3% in June. Building permits also ticked up higher during the month. Retail sales were unchanged in June, which was better than expected. Investors were encouraged that consumers were spending despite ongoing inflation. Key economic data coming out this week. On Tuesday, we have existing home sales. Wednesday is new home sales and the survey of business uncertainty. Thursday is gross domestic product, durable goods, international trading goods, and jobless claims. And then Friday, personal income and outlays and consumer sentiment. Companies reporting earnings this week. Today on Monday is Verizon. Tomorrow on Tuesday is Alphabet, Tesla, Visa, Coca-Cola, Texas Instruments, GE Aerospace, Philip Morris, and United Parcel Service. Wednesday is IBM and AT&T, and Thursday is AbbVie, Union Pacific, and Honeywell. All right, so that's some good stuff there. All right, well, let's move on over to the market recap. U.S. stocks rise as Nvidia-led rebound ahead of big tech earnings. All right. On Monday, the SP 500 surged, led by a rebound in tech stocks, particularly Nvidia, as investors anticipated quarterly earnings from major tech companies. Nvidia jumped 4% following a Reuters report that the company is developing a B20 version of its Blackwell GPU for the Chinese market to comply with U.S. export controls. This development helped lift the broader tech sector, prompting dip buying as investors looked forward to upcoming earnings from tech giants like Alphabet and Tesla, set to report on Tuesday. Wedbush expressed optimism about Alphabet's upcoming earnings, citing strong performance in Google search based on ad surveys and agency feedback. Additionally, Tesla's CEO Elon Musk announced plans to deploy humanoid robots for internal use next year, adding to the anticipation. Ooh, it's kind of like Terminator. Let's see here. Next up, President Joe Biden announces withdrawal from the 2024 presidential race amid concerns over his mental health and effectiveness against Republican candidate Donald Trump. His mental health. I don't think there's been anything moving between the 2 years in quite some time with Joe. Biden endorsed Vice President Kamala Harris as his successor, but she still requires official nomination by the Democratic Party in August. Trump was recently nominated as the Republican presidential candidate. Polls indicated Trump performing better than Biden and slightly ahead of Harris. Democratic leaders, including former House Speaker Nancy Pelosi, have endorsed Harris, hoping for a Harris-driven boost in upcoming polls. Yeah, Nancy was like shoving him out the door or off the cliff, like that meme where the girl's pushing the wheelchair and whoop, right over the side. All right, more back into it. IQVIA Holdings, Inc. Saw a rise of over 6% after reporting strong quarterly results, driven by its technology and analytics business. Conversely, Verizon Communications fell 6% following a revenue miss in its second quarter results, despite adding more wireless subscribers than expected. In summary, the S&P 500's rise was fueled by a tech rebound led by Nvidia, anticipation of earnings from major tech companies, significant political developments with Biden's withdrawal from the presidential race, and mixed earnings reports from key companies. All righty. Next up, I got an article here. It's from Mr. Brian Westbury at First Trust. This week's article is titled Moderate Growth in Q2. So let's see what Brian had to say here. Signs indicate that U.S. economic growth is decelerating. Jobless claims, a key high-frequency economic indicator, have risen to an average of 235,000 per week over the last 4 weeks compared to 211 in the first quarter. Continuing jobless claims are also increasing, and overall retail sales have grown by just 0.2% over the past 6 months, which is slower than the inflation rate. Although the U.S. is not currently in recession, the combination of higher jobless claims, tepid retail sales, and renewed deceleration in inflation, consumer prices dipped by 0.1% in June, suggests that the decline in the M2 money supply from early 22 through late 23 is starting to have an effect. Well, we shall see, Brian. Additionally, the temporary and artificial impact of last year's budget deficit surge appears to be waning. Without the Supreme Court's decision to overturn much of President Biden's student loan forgiveness plan, the budget deficit would have been 7.5% of GDP last year, significantly higher than any non-war year, with unemployment below 4%. In the second quarter, real GDP is estimated to have expanded at 2.1% annual rate, primarily driven by an increase in consumer spending. This estimate may be adjusted based on upcoming reports on international trade and inventories. Inflation-adjusted retail sales, excluding autos, grew at a 0.3% annual rate, while auto sales rebounded at a 9.8% rate. Real services grew at a 2.1% pace. Overall, real consumer spending on goods and services increased at a 2.1% rate, contributing 1.4% percentage points to real GDP growth. Business investment estimated to grow at a 1.7% rate, led by gains in intellectual property, while commercial construction saw a slight decline. This contributed 0.2 percentage points to GDP growth. In home building, despite high mortgage rates, residential construction grew at a 4.9% rate, adding 0.2 percentage points to GDP. Government spending, direct government purchases of goods and services rose at a 1.7% rate, contributing 0.3% to GDP. Trade, the trade deficit expanded as imports grew faster than exports, resulting in a subtraction of 0.8 0.8 percentage points. Inventory accumulation increased in Q2, adding to an estimated 0.8 percentage points to GDP. Overall, these factors combined to produce an estimated 2.1% annual real GDP growth rate for the second quarter. This is positive compared to a recession, but not an ideal starting point if tighter money policies start to have a greater impact. Okay, a lot of good data there. All right, next up is an article here. I saw this last night, so I figured I'd share it. It was published on Friday, the 12th, but it comes from CNBC. It's titled, "Here's the Deflation Breakdown for June 2024 in one chart." So we're going to go through this. It's, yes, these are prices going down, but considering most things are up 20 to 40%, granted, some things are higher and lower, but and the money supply increased by 40%. Everything is just, a third more than it was, 4 years ago. So let's read through the summary of this and see where we can poke some holes in it. Inflation has significantly reduced since its peak 2 years ago, with some consumer prices even experiencing deflation. Deflation, which measures the rate at which prices decrease, contrasts with inflation, the rate at which prices increase. Thank you for that definition. Economists note that deflation has mainly occurred in physical goods over the past year due to normalizing supply and demand dynamics disrupted by the pandemic. Since June of 23, core goods, excluding food and energy, have decreased by an average of 1.8%, according to the Consumer Price Index. 40% growth, 2% reduction. Nice. Several categories have experienced notable price drops, including home furniture, appliances, toys, dishes, flatware, and outdoor equipment. Additionally, new vehicles prices have fallen by over 1%, and used prices have fallen by about 10%, influenced by improved inventory and high financing costs. The initial surge in demand for goods during the pandemic, coupled with supply chain disruptions, drove prices up. I'd argue it was the increase in the money supply, but you can believe whatever you want. However, the reduced pandemic-era craze for home improvements and office upgrades, along with resolved supply chain issues, has cooled prices. Furthermore, the strong U.S. dollar has made importing cheaper for U.S. companies, helping to lower prices. Food prices have declined for items like ham, rice, potatoes, coffee, milk, and cheese, each influenced by specific supply and demand factors. Gasoline prices have dropped by 2.5% due to weak demand. Again, 40%, 2.5%. Increased supply and falling oil costs. Well, oil's actually been going up this year. Travel-related prices, including airline fares, hotel rates, and car rentals, have also decreased, driven by factors like increased seat availability and consumer price sensitivity. Some deflationary effects might be more apparent in official statistics, which account for quality improvements over time, like in products like electronics. Overall, while deflation has been observed in various categories, broad and sustained price decreases across the economy are unlikely without recession. The easing of inflation supports the case for potential rate cuts by the Federal Reserve. Yeah, and if we go down here, here's the chart that, let me make that larger for you so you can see it. So at home, the biggest jump is apples. Apples are down 12%, because I buy, crates of apples. I eat them all. Actually, I never eat apples. Ham down 4.3%, potatoes down 3.9%, and rice down 2.4%. So this is their big, hey, you're saving a lot of money, American consumers, is because apples are down 12%. Now, other goods, we already talked about gasoline down 2.6. Other goods, less food and energy. Telephone hardware and calculators are down 12%. Well, let me tell you, I'm always out there buying telephones. I got them all over my house. And calculators, who could not live without a calculator? Oh, wait, all that crap's on my cell phone. What? And then next down, dishes and flatware down 10% because, I break all my dishes every day. I don't even wash them. I just throw them at the fireplace, like it was at the Greek people. Used cars and trucks down 10. That makes sense. If you've got too much inventory and it's sitting there. And then men's suits, sport coats, and outerwears down 9.4. So, yeah, it's kind of, and then they show the chart of the CPI up peaking around 9 and then down here around 3. So in here, it would have to go into negative territory for it to actually start to see some improvement. Anyways, I thought that was funny. And I mean, again, the average consumer reads that and says, looks like, the people in charge are doing a good job, and prices are going down. Yeah, for apples. Anyways. All right, last up, an article from Zero Hedge. This one titled Central Banks Purchase Gold to Offset Their Own Money Destruction. This was written by Daniel LeCal. All right, gold prices have been rising despite the global economy not being in recession and inflation seemingly under control. Inflation is decreased, but still significant, with the central bank with the U.S. at 3% annualized and the Eurozone at 2.6%, with some countries higher. Central banks appearing hawkish, have maintained accommodative monetary policies such as money supply growth and liquidity injections. Gold's price has exceeded $2,400 an ounce, up 16.5% from January to July of 2024, outperforming major stock indices like the SP 500 and the Stock 600. Investors are betting on continued central bank expansionary policies due to unsustainable deficits, seeking gold to hedge against currency debasement and inflation. Central banks have been significant buyers of gold, strengthening their balance sheets and reducing reliance on fiat currencies like the dollar and the euro. For instance, China and India's central banks have been increasing their gold reserves to mitigate exposure to government securities. In 2022 and 23, central banks purchased over 1,000 tons of gold annually, accounting for almost a quarter of the global gold demand despite limited supply growth. Global official gold reserves increased by 290 net tons in Q1 of 2024, the highest since 2000. Central banks in China, India, Kazakhstan, Singapore, Qatar, Turkey, and Oman have been major buyers, aiming to balance their reserves. European central banks in the Czech Republic and Poland have also increased their gold holdings. This trend is not about de-dollarization, but balancing central bank balance sheets against the volatility of government bonds. The move reflects a response to the anticipated erosion of purchasing power of reserve currencies due to aggressive fiscal and monetary policies, meaning money printing. Central banks are thus rebalancing their portfolios to mitigate losses from government bonds and prepare for potential inflationary pressures. In conclusion, gold is seen as stable, low volatility asset that offers strong long-term returns, especially in an environment of monetary expansion and economic uncertainty. All right. So that is everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. If you need to get your financial crap together, give me a buzz. I'd be happy to help. All right. Well, like I said, that's everything that I got. I hope everyone has a wonderful evening out there, and I shall talk to you again next time. Adios.